Hi, Jerry.
Hi, Kim. How are you today?
I'm well. How about you?
I'm doing well, thanks.
Good, good. I'm glad that we were able to come together today. Um, I think that we should probably address a few concerns and questions that we're getting some feedback on from our podcast.
Yeah,
Um, it's still centering around, how can we do this, right?
yeah,
How come notes is a good investment to as far as an asset? Why should the whole thought process of investing in notes, how come the government accepts this? Because, we're talking about mortgage notes. These are not,
yeah,
the normal Wall Street commodities that we know about, right? So um, I think that if we can maybe go through it succinctly to address
sure.
some concerns and questions that we discussed earlier, it might be helpful to have that on our channel for people to reference. How you feel about that?
I think that's a great idea.
Me too.
I think that we are getting feedback, good constructive feedback, and some of the things I'm going to be talking about. One of the folks that probably will be listening, he will think that I plagiarized his questions.
But it's good that at least our viewers will know that we're listening and
Yeah,
that we want to be able to clear up any concerns or questions, and make people feel more comfortable about notes, about investing in notes. I do like the fact that now we're getting questions. We
yeah,
weren't getting questions before. We weren't getting that kind of feedback. So people are really starting to embrace it. So
yeah.
before we get started, welcome to the Kim and Jerry podcast. And also, I just want to say that this is for the purposes of education and information only. We are not CPAs, attorneys, or family planners or advisors, but we do like to share and help others understand what we consider our expertise in the note industry, mortgage note industry investing, and want to make sure that people know that they have someplace they can go to ask the questions that they have. But by all means, seek your professional to get the direction that you need to finalize your decision investing in mortgage notes. So, with that, Jerry, I'm going to turn it over to you
Okay.
and let you start off. And as I think about what you're saying and remember some of the questions that were posed to me, I'll interject.
All right, sounds like a plan.
Okay.
One of the things that folks were asking about is risk. And, what's the risk of investing in notes? How risky is it? What do I have to be concerned about? And the first thing I want to say is that for most folks, when you use the term risk, you use the term investment, it's scary.
Right.
And it kind of reminds me of like when I was a little kid, a real little kid, and I was afraid that there was when I'd get up out of bed at night, somebody would grab my leg.
Yeah.
And after I grew up a little, or got a little older, I realized there's nobody under the bed.
Right. So it's a
So
self-imposed kind of fear almost, right?
yeah,
That would
so
because you
risk
don't
is
know any
scary.
better.
Yeah, risk is scary. So let's back up and let's talk a little bit about what is risk in the investment world. Because you'll
Okay.
hear things like risk return and risk adjusted this and
Right, right,
whatever,
right.
but most of us don't really understand what does that mean. So risk from an investment perspective has a couple of components. One is volatility. So if you think about the stock market, you don't know how high it's going to go or how low
Right,
it's going to go. You just know it's going to go up and down.
right,
Well, that up and down, that volatility is risk.
right.
The other thing about, if you're investing in the stock market, the volatility, the frequency of those ups and downs is also risk
Right.
because we don't know how fast the stock is going to change or it's going to adjust. So when you hear the term volatility, that's what we're talking about. How much up and down? How often does it happen? How frequently does it happen? That's all part of risk. And as an investor, you're trying to manage that volatility and the cycles in which that happens. So, I use the stocks because we're all kind of familiar with stocks because you hear the Dow Jones average hit 40,000 the other day, that kind of thing. None of us knows what that means.
But they report it daily.
They report it. Yeah. So I say that The other thing that I'll say is that, when we're looking at stocks, individual stocks are much more volatile than indexes. And you're going to hear that as well.
Right.
So having said that, I wanted to kind of use that as a way to kind of explain volatility, and then now talk a little bit about notes and why notes are less risky, i.e. less volatile than other investment classes. One
Are
of
you
the
going to
reasons,
go into the whole, like even the outside factors that people also feel like they don't have control over, which
yes,
can then in turn, okay, so
yeah,
I'll stay
yeah.
off it. Go ahead.
So, so when we talk about risk, one of the things that you're looking for is ways to mitigate or dampen out that risk.
Hmm.
So when we're talking about stocks, individual stocks, highly volatile, but maybe we go to an index fund, which is less volatile, still volatile, but maybe it doesn't have as wild swings. So now we go back and we talk about notes. Notes are less volatile. Why are they less volatile? One of the reasons is the value of the note is a percentage of the value of the house.
Hmm.
So the underlying asset, worst case, it's the value of the house. So there is a floor on how far a note could drop if it were to drop. So you don't have that
Right.
level of volatility. The other thing that I'll say is because it's fixed to the house, housing prices don't go up and down every day. They're
Right.
pretty much the same all the time. As a result, again, less volatility, i.e. less risk. The other thing that I'll say about note, so the value of the note, because it's based on the percentage of the value of the house, not going to change much. And then the other thing that's really consistent about notes is the price, which is, I should say, the payment. When you sign a mortgage, you know that for the next 10, 20, 30 years, this is what the payment's going to be. If it's $500 a month, it's going to be $500 a month. If it's $1,000 a month, it's going to be $1,000 a month for the next 360 months. So again, no volatility, which lowers your risk.
Right.
As a result, your risks are mitigated a bit.
Right.
The other
Right.
thing that I'll talk about with the risk mitigation for us and what we do, even though we know the value of the house is not going to change much, we know the payment is going to be consistent, we do other things to help mitigate the risk as well. And that's
Exactly.
what Kim was trying to allude to before, which she said, are you going to talk about that? What we do is our due diligence to make sure that it is a good note. We make sure that we are geographically dispersed. And so why geographically dispersed? If there are fires in California, you want it to be offset by rains in the east. Hurricanes in Florida, all those kinds of things. That's going into our thinking as we're building a portfolio to make sure that if there's an area that's up or down, we have something that offsets it somewhere else so that our cash flow is steady. Geographic dispersion. We also look at the equity in the property. And, so we don't buy a note unless a borrower has more to lose than we do.
Right.
So in many cases, the equity in the house far exceeds the note that we bought.
Right.
So as a result, we're again mitigating the possibility that something can happen. Now, granted, in life, bad things happen to good people. But if we've done all of these things to try to make sure that we have covered things that are risky and try to mitigate the risk, then we sleep well at night. And what I'll say is note investors typically sleep very well at night because
Right.
they're not concerned about, well, I'll wake up and my stock is half the price it was when I went to sleep.
Right, because it's not
No,
impacted by the market,
no,
right? It's impacted by the asset, right? The
yeah,
asset is what secures the note.
yes,
And knowing whether or not you have a good note is knowing whether or not you have a good asset and the factors that are involved in that asset that was taken for the purpose of investing.
yeah,
So I
mm,
think that, if people could understand that it's almost like rewiring your whole thought process when you're investing and building your portfolio, that notes is actually one of the best assets to invest in because it will stabilize your portfolio because of the build. It is very consistent, very constant, right? The
Yes.
volatility is not there as those that are typically in a portfolio.
So,
And the more we talk about it, and every now and then I see light bulbs go off, with people who I have been speaking with, and all of a sudden, you can say, okay, this is what you were referencing. This is what you're talking about. I'm beginning to feel more comfortable, which is the whole point of this conversation or our podcast, right? The purpose is to grow comfortable, is to provide knowledge, right? So that because when right, just like you were talking about the fear earlier, right? Then there is no fear. And then you can now make an informed decision and feel good and sleep well at night with your investment.
Absolutely. Yep. So one of the other things people have asked us about, Kim, is, what's the government say about this?
Oh yeah.
And I'm gonna back up before I get too deep into that, and I'll say that when you buy a house, for most of us that have purchased a house, you borrow the money from Bank A or mortgage company A, whatever, and then a couple of weeks later, a couple of months later, even a couple of days later, you get a letter in the mail that says somebody else now is your lender.
Right.
That somebody else is us.
Right.
We bought the mortgage from XYZ Bank, and now it's in our portfolio.
Right.
When that transaction that occurred in our world, we call that the secondary market.
Mm-hmm.
So mortgage notes are sold from the first entity that created them into the secondary market to be sent out or purchased by other entities.
Mm-hmm.
All of this, the secondary market, believe it or not, is almost 100 years old. And it was created by Congress.
That's right.
U.S. Congress.
Right.
It was created in the 1930s.
Yeah.
And the idea
like
was, what's that?
38, is that right?
34, 38. I get those dates mixed up. But it was created because there were several things that happened in that time period. But it was created because Congress wanted banks to loan more money so more houses could be built to put construction workers back to work.
Right.
It was in the middle of the Depression, they were trying to stimulate the economy.
Exactly.
Banks wanted to lend, but the problem was they could only lend the money they had. And after you lent that money, you needed to get more money. So Congress said, hey, what if we could set up a process, which we now call the secondary market, to get those loans that the banks have created sold off to somebody else that has cash. And that created the secondary market. That was when they created FHA, which many of folks on the podcast have heard about.
Yes.
Later, they created Fannie Mae, and they created Freddie Mac, and Ginnie Mae. So those are all government entities that help the different types of lending institutions take the mortgages that they've created and sell them out to other entities. Typically in those days, they're selling them to insurance companies, they're selling them to pension plans, they're selling them to hedge funds, people like that.
Right. So
government support, this is a government-sponsored thing, or at least a government-created thing. In 2008, when the market crashed, it opened up to smaller investors like us to be able to buy those types of loans. Prior to that, you had to have 10, 20, 30, $100 million to buy a bunch of loans from Citigroup or whatever. Today, you can buy them in much smaller amounts because the markets have opened up to allow other alternative investors to be able to participate.
Right. Are you going to talk about the different kind of relationships? Like, for example, I want to plug First Show Financial in regards to our relationships that we have with the secondary market funders, the hedge funds and the banks, et cetera. Because while this is a place where the notes are located, they're not truly accessible to every single, investor, one on, one off, there's a relationship that is required when you're in this industry. Are you grinning
Yep.
because we're talking about it? Am I stepping on your
No,
show?
no, the reason I was
Give you an
laughing is that,
opportunity to speak.
yeah, no, it's great. The reason I was laughing is that we buy from banks.
Okay.
And everybody that's listening to the podcast knows how difficult it is to talk to somebody at a
You
bank.
can't just walk in, you know?
You know, they don't want to talk to you,
Yeah.
and you know they want you to do everything online. Well, this is a
Yeah.
business where you can't necessarily do that piece of the relationship online. Yes,
Right.
we buy, we're transacting things through online vehicles, but it is a personal business where you have to know folks in the space in order to be able to buy notes. It's also an industry where you got to trust. You know, when I buy a note, the seller has to know I have the cash to pay for it, and I have to know that the seller actually owns the note that they're selling. So,
Right. No, but there is a big trust factor involved
sure.
in regards to who your seller is, right? Because, while notes are safe in regard to the prospect that we talked about, that there are still things that you still have to make sure are present. And when you have a relationship with a seller, there's an innate trust in the quality of the notes that you're buying from the seller,
Sure.
and
Sure.
to be able to pass that on to our investors, that's a big deal because there are some horror stories out there, and unfortunately, so that matters. And I just wanted to throw that out there.
All right. But the final question is, why are you guys successful? And why is note investing successful for us? And some of it, like I said, it's the relationships. It boils down to we are very disciplined. We have a process, and we follow and execute that process for every note that we buy, for how we manage the notes, for how we work with the borrowers, for how we work with the sellers, how we work with each of the members of our team and our investors in order to make sure that things flow the way they're supposed to flow. So the discipline is key for us. The other thing is our due diligence.
Yes.
We're due diligent. Our due diligence borders on being anal because we're looking at everything. And there are times when I'm thinking, guys, let's just buy the note. Let's stop debating, this piece of it because we're looking at the geography. We're looking at the house. And I remember, a recent house where somebody's going, is the roof line on that house a little crooked?
Yeah.
So the due diligence, because that's key. That's one of the things that makes us successful. The other thing is our experience in real estate, experience in the finance world, experience in construction, and experience in appraisals. Every aspect of the real estate
The
business,
records, right? The public
the
records.
records.
Yeah.
Yeah, we have folks on our team that are truly first rate in all of these things.
Right.
And we're
And
bringing
you
all of that
develop
together.
an eye, right? You do
Yeah,
this experience and expertise is a skill that becomes part of you, and you develop
yeah,
an eye for what you should be looking for, what adds up and doesn't add up. And in spite of, we know that there might be an exposure that we need to further investigate or at least get an explanation for. All these factors is something you can't truly just say it's done across the board, everywhere, every place, all the time. Everything, success, they always say success is the equivalent of your relationship. And the relationship that the company holds it with the seller, right? And our vendors that are involved that help support, give us the documentation in which we need to ensure that we have the property in which we think we do have to
sure.
invest in.
Absolutely. Absolutely. So another thing that sets us apart in addition to the experience is the knowledge. It's the
Yeah.
knowledge of the note world. It's the knowledge of the real estate world. It's the knowledge of various geographies. It's the knowledge of the players in the business, what do you say? What do you do? How do you do it? All of those things are part of the DNA of the First Shield organization, the First Shield community.
Yes.
And it only is education. I'll say that all the members of our team spend thousands of dollars a year getting educated.
Getting educated.
Going to conferences, taking classes,
The
reading,
webinars that we get online.
webinars,
And then we
books.
get invited by our, sellers. They invite us to their forums in which we can also
True.
glean from them.
True. And all of those things kind of are in that stew that kind of helps to, make us where we are or make us successful in what we do. I think you kind of throw that all together, and these are things that are not transferable.
Or that you even think to even express on a daily basis, like even when people have interest, you really can't give the back office of what we do that would help an individual feel that much more comfortable. It's one of those things that over time you begin to appreciate, especially when you can do some comparative analysis with the interaction and the investing with us versus the interaction and the investing with others, that you can see that where some things were done differently, good, bad, or indifferent, things were done differently. But you begin to know your seller. You begin to know the relationships that keep you in the circles of you having a good investment.
True.
I can't stress that enough because I have people who said that it's not the same. Let's leave it at that. It's not the same. And so we try to stay very consistent so that the expectation is there and people can trust that which we do with them as far as investors are concerned.
It's great.
Yeah.
So those are some of the questions that we've been hearing and, trying to answer some of those. I feel good about the notes. I think it's a great opportunity for someone, as Kim said, to stabilize your portfolio. It's a great opportunity for folks that are looking for steady passive income to be able to get that steady income, to get that passive income. It's a good investment vehicle.
I just want to run something by you that I hope that's okay to say here, but I did have someone that came back to me almost a year ago and was, I don't want to say annoyed with me, but that she said, "So you didn't tell me this was an exclusive relationship." She said, "I didn't know that I wouldn't be able to do this on my own. I didn't know that I needed so much more than what's portrayed." And that, we were talking a lot about relationships, but I think that that's something maybe we sometimes gets lost. We certainly encourage for you to work with us. We give all the support we can possibly give. But note investing, while it is very straightforward, I think, in regard to what your expectation can be of it, but there is a detailed process that's involved in ensuring that you're making a good investment, right? And it takes more than one set of eyes to look at that. As you said earlier, you just can't buy a note. You have to understand what you're buying and why you're buying it, and what are you going to do with it? Does it just sit in your portfolio? What if it doesn't sit? That's the type of thing. And so, investing, especially investing in a group like ours, you get the benefit of an assurity that you probably wouldn't get if you were just doing this on an individual basis, right? And I don't want to say it's an exclusive club or anything like that, but it definitely does put things in perspective where you just shouldn't jump out there and buy a note without understanding all that's involved and the ramifications. And as experienced as we are, and God knows, Jerry, you there's still a lot of detailed analysis that's going on to determine, what we have in hand to invest and also pass on to our investors.
Agreed.
And it takes a room full of us sometimes. So
That's true.
I just don't want people to feel like, okay, I can do this, before I go out on Friday night. Not quite, you know. You should feel really assured that this is really a fantastic investment model. I wish I knew about it sooner. I'm trying to get my 20-something kid in it, but at the same time, it does warrant that kind of commitment and understanding what you're investing in.
Absolutely. Absolutely.
I'm
Well,
sure I've rattled on enough. I don't really have anything more, but this is great. I
all
love
right.
this subject matter. And, I just feel like I can hear my phone and the text messages going off. Okay, so what about this? And what about that? So next podcast, we'll answer the what about this and the what about that. But I hope that people benefited from what we had to share today. Now, for us, we enjoy sharing what we know and what we can pass on, and hopes that people will be inspired and look at, how they can build their portfolio and strengthen it and stabilize it with mortgage notes.
All right.
I don't have anything more. Do you have anything more, Jerry?
Nothing other than, if you've heard the podcast and you enjoyed it, hit the like button down below,
Yes,
subscribe.
please subscribe.
And if you have questions, feel free to comment in the chat down below, or get on one of our calendars and talk one-on-one. We can tell you a lot more about the space, about what we're doing, and hopefully get more people invested in buying mortgage notes.
Yeah. Please join us at our website, ratiofinancial.com. And let us know what your thoughts are. Let us know if there's something you want us to address. Let us know if there's something we still haven't put our thumb on, because we want to do that for you. All right. Thank you, Jerry. As always, I appreciate you.
All
Take
right.
care.
Bye-bye.
All right. Bye-bye.